This is the uh, exam one short answer questions answers. Um, let's start with this one where we start with Falmart Limited. This is the GST question, and I'm gonna assume you've already got all these pages for all these short answers, and let's just jump right into the questions then. So first off, it looks like May the 8th, we purchased some inventory, and we are responsible for journal entries. That's the required, is prepare journal entries. So the journal entries for the first one, it's inventory that we're purchasing, and we're purchasing it for $10,500 on account. So it's accounts payable, and we know it's $10,500. Must be some. We're told that GST is included, GST recoverable, and if you did the math on this one, it would be 10,500 times 5 divided by 105 would equal, in this case, it's going to be $500. So we had $500 worth of GST that we paid, and we would have then $10,000 worth of inventory that we purchased. On the 12th, we sell inventory or merchandise to a Little Corner store for $15,000 on plus applicable GST, and we sold it on account. So we're going to have accounts receivable, and we know we'll have sales revenue as well, and we also know we're going to have GST payable, because whenever we sell something, we collect GST along with that, which we're told in the question is 5%. So we also know we sold some inventory. We got to get the cost out of our perpetual inventory system. So that's maybe even easier to do, cost of goods sold. So we move $8,000 into that account from inventory. So debiting cost of goods sold, crediting inventory. We know the sales are $15,000. They tell us in the question. So the GST on that would be 5%, which is $750. So that means that we need to collect from this customer $15,750. Great. On the 15th, we buy office supplies, and so that's office supplies expense. And we know that it's $100 plus GST, so it's $100, and then it's GST recoverable, and that's 5%, which is $5. And we paid for this on account. Do we pay for it on account? So it's accounts payable, and it's $105. 28th, we collect the balance from the customer, so that means we get cash, and in this case, got to follow, so we're going to get cash of $15,750, and that means our accounts receivable, we're clearing that out, and for $15,750. Perfect. June the 3rd, Falmart files their GST return, and we've got to record the journal entries for that. Well, if you're consistent, you've got to get rid of the GST payable, and the only GST that you collected was that $750 right there. And then you've got GST recoverable, and the only GST that you recovered is the $500 plus the $5, so that's $505. So the difference is the cash that you need to pay out, and so you would pay out cash $245. So that's the answer on that one. All right, on to the capital lease question. And they tell you it's a capital lease right off the hop. So what we've got here is a capital lease with Silverman Corp. 8-year lease on an office building. Annual lease payments $15,000. Excuse me, with first payment due immediately. Annual lease payments each January the 1st. Present value of the 7 future lease payments at 10% interest, $73,020. Okay, building expected to have a 10-year life. That's important for the amortization. And there's an option for the lessee to purchase the office building for $1 at the end of the lease. It's a capital lease. That is the bargain purchase option in part of the criteria for a capital lease. So It just confirms, yes, this is a capital lease. And they tell you that anyway, but regardless. So let's see what we do. We know right away we pay $15,000 in cash out. We know that the liability that we're going to pay afterwards is $73,020. So the total cash that we're going to end up paying out, these two, is 88,020. So that becomes the cost of the building. So that's the property, plant, and equipment account. Then we're going to amortize that 88,020. So that means we're going to have 4401 in terms of the amount of, sorry about that. Let's do that right. That's going to be 8802 and 8802 as the amount, because it's just divided over 10 years. Then our interest expense is just the accrual for the year. We signed this lease January 1, 2020. So now it's December the 31st of 2020. We got 1 year's worth of interest. So it's on that 73,000 and it's 10%. So that number should be 7302. So we have an expense of 7302 and an interest payable of 7302. You also could put capital lease liability in there, and that would be just fine. In fact, that's what the text likes. And then you'd have to put the same thing down here. So you'd have capital lease, interest payable that you'd wipe out with the payment of $15,000. And then the interest payable here is the 7302. So we'd accrued it right here, and then we wipe it out by making this $15,000 payment on January 1st of 2021. And the difference here, the amount of sort of principal reduction, is $76.98. You needed all that to get the marks, and there was quite a few people that got that, so that was good. Payroll question here. This is Tom Jones, who works for a company, and he's worked, it looks like he's worked 44 hours. He normally works 40 hours in a week, and he gets regular pay of $1,000. But when you come down to calculating his overtime, he's got 4 hours overtime, and his normal rate is 1,000 divided by 40, and he gets time and a half for that. So if you did the math on that thing, you should come up to, I believe it's $150. So it's $150 if you do the math. And the numbers fall out of there. So it's generally just a math exercise after that. Set up the wages expense of $11.50, just comes right off of there. If you came up with a different number, I checked to make sure you did the same thing here. And then this is math, whether this is 20% of gross earnings, so that must be 20% of that. This is 4.95% of that. This EI is 1.88% of that. And the difference is a salary payable. They tell you it's an accrual in Part B. It says accrual of Tom Jones payroll, so it was salaries payable, not cash. And then you've got to set up in January 31st again, which is Part 2 of B. We needed to know the employer's portion. So CPP just matches, EI is 1.4 times, and you'd have 1 mark for this, regardless of whether you use CPP expense and EI expense or just one number for employee benefits expense. It's the same thing, so that's good. And then employee income tax payable, we've got the payment here of the deductions on February the 3rd, actually, in this case, February the 3rd. And so we know we got to pay the income tax that we took off of the employee's paycheck, the $230. Same thing with the CPP, so $56.93 twice. That's that $113. EI payable, $51.89 is just the $21.62 and the $30.27. And that all comes to $395.74. And so that would get you full marks if you did that. And then the partnership income question. So in this case, okay. All right. We've got Huey, Dewey, and Louie. Each have some capital involved in this partnership, and we know that that we're firstly going to take the first 100,000 and allocate it in the ratio of their opening balance, their opening capital balances. So we set it up just like we normally would, sort of thing. Then the second part, we're allocating based on service, and it's $30,000 we're going to split, and then any remaining profits is just allocated equally. So, and we know our total income's $250,000. So the calculation here is just math again. So Huey has 200,000 of the total of 500,000 of equity. So this number then should end up being, I think it's $40,000 even. So it's $40,000 there. Dewey, you do the math. Dewey's got 184 of 500 in there, so that works out to 36,400, and then 36,800, and then Louis ends up with 23,200, and those all added up together should be 100,000, and it is. So now we've got 150,000 still to split, and it's based on service and in a ratio. It's based on a ratio of 2:1 to 3. So Huey gets 2.6, Dewey gets 1.6, Louis gets 3.6 times the 30,000. So that's fine. We get $10,000 here. The math on this one is $5,000, and on this one is $15,000. So, and we just gotta clean this up, minus that. Oops. Minus that. Gonna work. There we go. Minus that. There we go. And minus that. So we have $120,000 left over, which is to be split equally. So that's $40,000 each and $40,000 each. So you should have ended up here with 90,000, 81.8, and 72. And taking that just a little bit farther, the last part of the question asks you for the ending capital balance, and you needed to catch the opening capital balance at 200,000 first. And we're just doing Huey's, not Dewey's or Louis's. 200,000 to start. We've got income of 90,000. We've got $48,000 in drawings, being 12 times 4,000. And so your net, when you add that all up, 242,000. Hopefully that all worked out good for you.